the share price has done very poorly the last few weeks, and I think one of the reasons given is that there's an increased nervosity about the robustness of ownership rights in China, especially given sort of everything that's happening in Russia. And I don't want to. Well, we can go down that rabbit hole if we want to, but
that was an excerpt from a talk Robert Vinall recently gave, in which he discussed the similarities and differences between Russian and Chinese stocks. And we'll get to that clip and also what Charlie Munger thinks about Chinese stocks later in this video. But to first of all give you some context here. Basically, ever since the Russian invasion of Ukraine, Russian stocks have been absolutely crushed. Russian stocks that were considered to be worth multiple $billion just a few weeks ago are now worth only pennies, following the global economic sanctions imposed on Russia. And it almost seems like the horrific actions of the authoritarian state Russia, with all of its consequences, in a way highlighted the risks associated with Chinese stocks. As Perth Tolle recently said in an interview with Morningstar, from an investment standpoint, the biggest concern is not Russia, which is 3% of most benchmarks, but China, which is more than 30% of most emerging markets indices. You might want to call this risk associated with certain emerging markets equities and with Chinese and Russian equities autocracy risk. But what exactly is autocracy risk, and how likely is it that Chinese stocks will follow the same path as Russian stocks, and will they eventually be worth nothing? This is what we will discuss in this video, and so without further ado, let's get started. Alright, so I just used an interesting term in the introduction to this video, autocracy risk. Essentially, the term describes the idea that your diligent analysis of business fundamentals can basically be rendered irrelevant overnight due to a lack of transparency and a lack of rule of law in autocratic or authoritarian regimes. You might have spent hundreds of hours trying to understand the mode of a business, to understand the competitive landscape and environment, the unit economics, the growth outlook. Maybe you've even talked to the management team to assess the integrity of the business's leaders. But all of this, due diligence, may be completely worthless if, in an authoritarian state, a single person or maybe a small group of people, usually those running the country, change the rules of the game, and so, as I said, render your analysis worthless. This risk may best be illustrated by the performance of Chinese for-profit educational companies. Sure, investors were making very good money for a very long time. In fact, for many years, the education tech sector, the Chinese education tech sector, was thriving and worth tens of billions of dollars. And if you invested in the stock of New Oriental Education and Technology Group, for instance, you basically 20x'd your money over a 15-year period. That's a compounded annual growth rate of 22%. But when Chinese regulators banned companies that teach the school curriculum from making profits, from raising capital, or from going public, well, the stocks operating in that industry effectively went to zero. This really resembles Nassim Taleb's turkey analogy, in which a turkey is fed every day for many years. Every single feeding basically firmed up the turkey's belief that it is the general rule of life that he is fed every day by a friendly human being. However, one afternoon, the day before Thanksgiving, something unexpected happened. The once friendly human being showed up with an axe, and the turkey basically very quickly had to realize that all of its expectations that were built up over years were catastrophically wrong. And similarly, investors in the Chinese education tech sector also learned the hard way that their assumptions were simply horribly wrong. And another example of this phenomenon in the investing world are Russian stocks. We are seeing this right now. Those who invested in Russian stocks simply missed the risks that come with investing in Russian equity markets. Russia's attack on Ukraine is certainly quite an extreme example of the geopolitical risks that come with investing in autocratic countries, and investors owning Russian stocks got burned. They lost a lot of money. At first, the Russian stock market was effectively closed for I think 3 weeks in total, but eventually trading resumed, and I think the dramatic sell-off of Russian equities may best be illustrated with the performance of the MOEX Russia index, that at one point was down more than 50%, despite the fact that even before the Russian invasion, Russian stocks were trading at a steep discount to comparable international equities. So when you consider these two examples, you might realize that investing in authoritarian countries represents a real risk, and that having 30, 40 or even 50% of your portfolio exposed to these autocracies is maybe not the best of ideas when it comes to constructing a reasonably diversified portfolio. So the question here is whether investors that own Chinese stocks also need to reassess the autocracy risk of their investments. And I think the Russia situation may actually be a wake-up call for those that made substantial bets on Chinese equities. I would argue that investors that own Chinese stocks may be worried because, at least at a surface level, there seem to be a couple of similarities between Russia and China. Both are by some perceived to be communist systems, even though to me, let me just say that right away, the Chinese system appears to be much more capitalistic in nature than the Russian one. Both have autocratic leaders with a lot of power. And both in a way are sometimes perceived as opposing systems to the democratic capitalism of Western countries. And China in particular is most certainly competing with the US in particular for being the world's most dominant power. So they are certainly, or I would say there is certainly a great rivalry between these two countries. So I would say this view of China represents one end of the spectrum of how China and its equity markets may be perceived. You would argue that China, essentially just like Russia, is a mafia state, and that China's and Russia's worldviews are fundamentally aligned. You would argue that due to all of the similarities that I just mentioned, and due to the autocratic nature of China, Chinese stocks are also destined to become worth nothing eventually. Maybe not right now, but at some point in time, maybe when a major conflict between the US and China arises, maybe when China decides to invade Taiwan. Let me just quote here what fellow investor Marcelo Lima recently tweeted on Twitter. There's this old saying that you can't make a good deal with a bad guy. I don't think the CCP are good guys. Of course, they are going to promise that now. It's in their interest. But if or when they do something that leads to US sanctions, all promises can and will be abrogated. Nobody thought Putin was going to invade Ukraine because it wasn't in his best interest. And yet, here we are. Countries routinely do things against their own self-interest. So essentially, you'd make the case that when it comes to investing in autocratic countries such as Russia and China, the normal rules of picking stocks, so business valuation or the taking a look at the fundamental outlook of a company or a country, those aspects aren't relevant anymore. And maybe this is why Morgan Stanley quite recently called China, quote, uninvestable. But then on the other end of the spectrum, you have a more optimistic view of China. According to this view, despite China's non-democratic political system, the presence of a rule of law framework deters mafia-style operations. And I think you can certainly argue that despite all of the similarities between China and Russia, both countries are actually very different. They have different approaches to global governance, to international affairs, to capitalism, and globalization in general. And so the hypothesis here is that in China, rule of law is actually well established, that investor-friendly principles are in place, and that foreign investors will be treated fairly. And thus, investors can approach these markets with a focus on business fundamentals and value companies and stocks based on these fundamentals. Now, please let me know in the comments down below where on this spectrum you would put China and Chinese equities. And of course, leaving a like and subscribing to the channel is also much appreciated. Personally, I would argue that the latter, the more optimistic perception, certainly reflects how Charlie Munger feels about China and Chinese stocks. During the most recent daily journal shareholder meeting, he said that, quote, "Assuming there's a reasonable honor among civilized nations, the risk of investors not having a claim on the profits of Chinese companies doesn't seem to be very high to him." And I would actually like to show you a short clip of what Munger said the year prior to this year's shareholder meeting in 2021 about the Chinese system.
Well, it's natural for people to think their own civilization and their own nation is better than everybody else. But everybody can't be better than everybody else. You're right, China's economic record among the big nations is the best that ever existed in the history of the world. And that's very interesting. A lot of people assume that free speech is required to have a booming economy as prescribed by Adam Smith. But the Chinese have proved you don't need free speech to have a wonderful economy. They just copied Adam Smith and left out the free speech, and it worked fine for them. So I think what China has done was probably right for China, and that we shouldn't be so pompous as to be telling the Chinese they ought to behave like us because we like ourselves and our system. It's entirely possible that our system is right for us and their system is right for them.
So, according to Munger, the Chinese system is of course different from the capitalism practice in Western democracies. But that doesn't mean that China's system is fundamentally flawed and that foreign investors cannot make money as long as the rules-based system in China is intact. And you could argue that an economy as big as China's cannot function without some basic rule of law principles in place. And this is most certainly how Dennis Hong feels about Chinese equities and the Chinese system. To quote him here, "I think most people don't understand how much rigorous and diverse debate happens in the government. The narrative that a $15 trillion economy runs on the efforts of a single person without basic rule of law seems like an improbable context. As one of my most thoughtful Chinese friends put it, it's not possible for a $12 trillion economy to function properly without some basic levels of integrity in the system." Now, quite frankly, I have never been to China and I've also never been to Russia. So everything I say in this video should actually be taken with a grain of salt. So what I would like to do here is to reference another investor that is, I would argue, well informed about his investments in China. And that's Robert Vinall, who owns, a quite significant stake in Alibaba. So let me just show you what he had to say about Chinese and Russian equities during his fund's most recent shareholder meeting just, I think, 2 weeks ago, and where he would put China on the spectrum that we have just presented to you.
I really view Russia and China as very, very different things. I know from the perspective of someone based in the US or Europe who's never been to either Russia or China, and both seem to be vaguely sort of previously communist and with autocratic sort of leaders, it can feel like it's sort of more or less the same type of thing. But if you've spent any time in China in particular, the two countries couldn't be more different in my view. Russia is effectively a mafia state in my view. I think that's been clear to people for many years, and it's obviously very sadly been shown to be the case over the events of the last few weeks. Putin has done nothing for his people. There's the company hasn't developed in any way. The life expectancy of males has declined. You have a small minority of hugely wealthy people, but that wealth has come from effectively stealing state assets as opposed to creating businesses. I saw one idiotic comment comparing Russian oligarchs to Jeff Bezos. Jeff Bezos created one of the greatest businesses the world has ever seen that creates value for everyone on this planet. The difference to a Russian oligarch just couldn't be more different. And then you compare that to China, and I think China is the opposite to that in almost every respect. It was a struggling third world country 40 years ago, and it's risen now to being, it's on track to become the largest economy in the world. And it's been an incredible development of human potential. Hundreds of millions of people moved from poverty on the countryside into cities. Incredible companies created, incredible increases in wealth. It really couldn't be more different in my view. And so if, the questioner is sort of implying, look what's happened to Russia, China is next, then that's just a hypothesis which I just don't agree with.
So Robert Vinall is essentially talking about the success story of China over the last couple of decades. And just to back up what he was just saying with some actual data, let me show you how the life expectancy in Russia and China developed. We can certainly see a more positive long-term trend for China, almost doubling the life expectancy of its citizens, although to be fair, they've come from a very low base 70 years ago. But we can also look at other metrics, such as GDP per capita. In China, GDP per capita was around $300 in 1990, while in Russia it was $3,500. Fast forward to today, and China has 30x'd that figure, while Russia, on the other hand, only 3x'd it. You can also compare the number of millionaires in each country. There are around 270,000 millionaires in Russia, and in comparison, there are more than 5 million millionaires in China. And finally, China is becoming more and more innovative. They've used to be known to just copy what other people had already invented, but this seems to change. This Statista bar chart here shows how the number of patent applications of companies in China developed between 2004 and 2020. And according to the World Intellectual Property Organization, China filed almost 50 times more patent applications than Russia in 2020. One could argue that Russia is not known to be particularly innovative. The nation's wealth primarily relies on the country's natural resources like coal, gas, and oil. And fossil fuel exports account for around 50 to 60% of all Russian exports. If you want to learn more about the opportunities in Chinese equities, you should watch the following video in which I discuss why investors can be bullish about the long-term prospects of Chinese stocks.